Hi, my name is khairunnisa Binti razak and I'm from MBA1194C. So today I'm going to explain to you about chapter 1 in Fin 320, which is Introduction to Financial Management. There's three components that in finance that are main, which is managerial finance. Secondly is financial market. Thirdly is investment, which is make a positive return in the field. For financial market, it's more securely sector. Definition of management. I will explain 2 out of 5. The first one is S.N. Maheshwari 2014, which is it is concerned with raising financial resource and their effective utilization toward achieving the organization goals. Secondly is I.M. Pandey, which is 2011, and the financial management for this definition is managerial activity, which is concerned with planning and controlling of the firm financial resource. And the goals of the organization is maximize the shareholder wealth through maximizing the price of the firm common stock. This is because there's three components that show us that the reason they prefer a profit for the wealth shareholder rather than maximizing profit. For first one is the time pattern of return. Even though a large return is expected 20 years, very few shareholders will wait for that long to get a firm return project. For shareholder maximize the taken as an objective of the firm. Secondly is risk. If profit maximization is taken objective of a firm, financial manager will look for the project that's offer the highest return without considering the risk that is associated with expected return. As normally, the higher return, the higher the risk involved. For the third one is dividend policy. Firm with aim only to maximize the profit will never pay dividend. Firms sometimes experience increase in earning without favorable change in market stock price. However, when earning increase, a company will payment of the dividend it would affect the value of the stock. There's 5 functions of financial manager. The first one is performing financial analysis, which must able to transform financial data into form that can be used to monitor the firm financial condition. Then we have financial forecasting and planning, which is planning manager must be able to estimate the future financing need to support increase in production at capacity. And then we have financial decision, doing in-depth of analysis, available financing alternative, their costs, and their long-run implication of the firm financial condition. And then we have making investment decision, determine the amount and composition of current and fixed asset held by a firm to run its business activities. Decision regarding of the optimal level of each type of current asset when the existing fixed asset need to be modified or replaced must be met, which is the cost as it is. And then we have asset management decision. A financial manager must manage the firm asset efficiency to ensure the firm get most benefit out of this asset. The definition of financial market is it is a marketplace in which people buy and sell financial assets such as bonds, equities, and derivatives. It can divide into 2 markets. Money market is financial market to raise the term financing in which short-term instrument. Short-term with high liquidity. And for the capital market is financial market for buying and selling a long-term debt and equity securities. That's all from me. I'm gonna pass it to my other member.
Hi, Assalamualaikum. My name is Nathasya Binti Shahidan, and I am from MBA1194C. And today I would like to share with you guys chapter 2 of subject financial analysis, which is depreciation and taxation. Let me explain the definition of depreciation. Depreciation is the process of allocating the cost of fixed asset over its estimated useful life. A non-cash expense whereby it is just recognition of the expense as the asset is used over time. Next, depreciation of tangible asset. Tangible assets such as building, plants, machinery are depreciated, whereas assets such as land is not depreciated. What about the differences between depreciation and depletion? Depreciation deals with tangible asset, while depletion attempts to measure the wearing away of natural resource such as mineral deposit and timberland. Next, the differences between depreciation and accumulated depreciation. Depreciation is the expense is calculated for each period and it is considered as an operating expense in the income statement, while accumulated depreciation is the total depreciation expense from the first year until the present academic year. It is found in a balance sheet. There are three methods of depreciation, which is first, straight line method, second, double declining balance method, and the third is sum of the year digit method. First of all, the straight line method. Under this method, depreciation is allocated equally over the estimated life of the asset. The formula to find the depreciation in this method is cost minus salvage value, then divided by useful life, or construct a depreciation table. Next, double declining balance method. It is the accelerated depreciation method, which means relatively a large amount of depreciation is allocated in the early years of life of the asset and a smaller amount in the later years. Formula for find depreciation rate is 1 divided by useful life, then multiply by 2. Then the formula to find annual depreciation is 1 divided by useful life, then multiply by 2 and multiply by beginning book value. Then, as same as straight line method, construct a depreciation table. Next, sum of the years digit method. It is produces more depreciation expense in the early years of the asset use. The formula for sum of digit or SOD is useful life multiplied by useful life plus 1, then divided by 2. Whereas, formula to find annual depreciation is remaining useful life multiplied by cost minus salvage value, then divided by sum of digit or SOD. Then, as same as straight line method, construct a depreciation table for sum of the years digit method. Next, how to compute of taxation. There are 8 steps, which is first, find accumulated depreciation for how many years the asset has been used. As example, accumulated depreciation using straight line method is cost minus salvage value divided by useful life multiply used years. Second, find book value, which is initial cost minus accumulated depreciation. Third, find capital gain or loss, which is selling price minus initial cost. If capital gains, need to calculate the capital gain tax. If capital loss, no need to calculate the capital gain tax. Fourth, find profit or loss, which is selling price minus book value. If profit, then calculate tax on RAD, and if loss, then calculate tax saving. Fifth, compute tax on recaptured accumulated depreciation RAD, which is profit at accumulated depreciation multiply corporate tax rate. Sixth, compute tax on capital gain, which is capital gain multiply capital gain tax rate. And seventh, compute tax on EBT, which is earning before tax multiply corporate tax rate. And last but not least, total tax liability, which is tax on RAD plus tax on capital gain plus tax on EBT.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Husna Binti M Jaffri. I am from MBA1194C. I would like to explain about Chapter 4, which is risk and return relationship. Risk is the potential for unforeseen events to occur, and return is the expected benefit of the investment. Relationship between risk and return is positive relationship, which is the higher the potential return of an investment, the higher the risk. Difference between risk and uncertainty. Risk, as we know, is the potential for unforeseen event to occur. Uncertainty is outcome whose probability cannot be estimated. Category of risk preference investor. we have three categories, which is risk neutral, risk seeking, and risk averse. Firstly, risk neutral, which is the investor who look over the risk because they are concerned about the return. Second, risk seeking, the investor who take riskier decision with expected high return. Lastly, risk averse, which is the investor dislike risk and prefer the safe one, which is lower return. Type of risk, we have two types, which is systematic risk and unsystematic risk. Systematic risk is known as market risk, may influence a whole economy market or a major proportion of the whole market, losing asset as a result of factors such as political risk and macroeconomic risk. Diversification cannot easily minimize market risk, while recession and radical change in monetary policy are including market risk. Second type is unsystematic risk, which is referred to as specific risk which impact only one sector or organization. Example include a change in management, the recall of product, a regulation change that may drive business sell down. Investors generally control and systematic risk by investing in a variety of assets through diversification. Method of reducing risk. First, get insurance. With getting insurance, it will protect your business when an accident or any natural disaster happens. Second, diversify your product and service. This will assist in maintaining the public's interest in your firm. It can also provide an advantage over your competition. Third, limit your business loan. Business loan can represent a risk to your company. So if you cannot avoid it, make sure that the one you're getting is manageable and had the least interest. Tools to measure risk. Okay, standard deviation and coefficient of variation are two statistical metrics used to assess risk. A high risk is linked with a high standard deviation and coefficient of variation. Calculation of risk and return. Firstly, we need to calculate expected return and then variance. Next, we calculate standard deviation. Then last step is calculate coefficient of variation.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nadzmi Bin Sukardi. Today I want to explain about Chapter 5, Cost of Capital, Finance Analysis 320. Okay, first we go to 5.1. It is sources long-term financing. A. It is debt or bond. B. Preferred stock. C. Common equity equal to common stock plus retained earnings. Next, we go to 5.2. The difference among the sources of long-term financing. For bond, it is long-term promissory notes issued by firms, and common stock represent ownership's position in the firm. For preferred stock, it is hybrid security with fixed dividend but without maturity period. So for bond, the par value is RM1000. For common stock, RM1 ringgit, and preferred stock RM100. For bond, it has maturity period, and for common stock and preferred stock, it has no maturity period. Bond is a liability, and for common stock and preferred stock is an equity. Bond is an interest. For common stock and preferred stock is an dividend. Next, we go to calculation of cost of each sources of financing. So I choose the example 1 here. If you can see that there is information given in the questions. So from the information given, you need to find bond before tax, bond after tax, cost of preferred stock, common stock, and retained earnings. So after you got the information given, A, it is the formula and example of how you calculate the bond before tax in the red circle. So in the green circle, the formula and example how you calculate the bond after tax. So after you got both of these, you need to find another information about cost of preferred stock, common stock and retained earnings. So as you can see here, B in the blue circle is how you calculate the cost of preferred stock from the information given, just like dividend rate, selling price, floating cost. You can calculate the cost of preferred stock. So in the black circle, in the right, bottom right, it is how you calculate common stock, C. And then D is how you calculate the retained earnings. So you need to first get the information given in the question first, and then you can calculate all of this. So that's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Aizzat Nabil bin Roslim. I'm from MBA1194C. So today I would like to explain about chapter 6, which is operating leverage and break-even analysis. Definition of fixed operating cost is it does not vary proportionately with the level of sales. It remains relatively constant regardless of the increase in the sales volume. For example, rent, insurance premium, and property taxes. Definition of variable operating cost is it moves directly with the level of output. The cost increase, output increase. For example, selling commission, cost of raw material, and direct labor costs. Definition of operating leverage is it is the responsiveness of earning before interest and tax, which is a bit to the change of sales volume due to the use of fixed costs by the firm. So next is, what is DOL? DOL is the degree of operating leverage. It is a multiple that measures how much the operating income of a company will change in response to a change in sales. Company with a large proportion of fixed to variable costs have higher levels of operating leverage. DOL also is the percentage change in EBIT resulting from a percentage change in sales. There are three formulas to measure degree operation leverage. The first one is DOL equal to percentage change in EBIT divided by percentage change in sales. The second one is DOL equal to sales minus variable cost divided by sales minus variable cost minus fixed cost. The last one is DOL equal to S open bracket P minus V close bracket divided by X open bracket P minus V close bracket minus F. So P represent as a price per unit, V represent as variable cost per unit, and F represent as a total cost. Interpretation of degree of operating leverage. If DOL is positive number, for example, DOS equal to 1.27 times, it means that if sales increase by 1%, EBIT will increase by 1.27%. If DOL is negative number, for example, DOL equals to negative 1.53, it means that if sales decrease by 1%, EBIT will decrease by 1.53%. Break-even analysis is a method used to determine the level of sales that a firm must is reached to cover its operating costs. Break-even happens when operating income is equal to zero, which implies that sales revenue are equal to costs. There are many formulas to find break-even point. So this is the formula to find break-even point. So that's all from me. Thank you.
Okay, Assalamualaikum. My name is Aishah binti Wera. I am from MBA1194C. I would like to talk about chapter 7. The topics is financial leverage and capital structure. Okay, the definition of leverage is the magnifying effect of using fixed costs on the returns to the shareholders. It refers to the use of debt or borrow funds to amplify returns from an investment or project. The concept of leverage can also used by both investors and companies. Okay, the leverage can be divided by three types, which are operating leverage, financial leverage, and total leverage. Operating leverage occurs when a firm incurs fixed costs which are to be recovered out of sales revenue irrespective of the volume of business in a period. Operating leverage is the relationship between sales and earnings before interest and taxes, which is namely EBIT. And fixed costs have to be paid regardless of the level of the firm's sales. Operating leverage is also associated with operating risk or business risk. So due to the existence of fixed costs, EBIT will increase or decrease at higher percentage than the increase or decrease in sales. Operating leverage can be measured by the degree of operating leverage too. So the importance of operating leverage, it gives an idea about the impact of the changes in sales on the operating income of the firm. And high degree of operating leverage indicates increase in operating profit or EBIT. Second, financial leverage, it is primarily concerned with the financial activities which involve raising of funds from the source for which a firm has to bear fixed changes such as interest expenses, loan fees, and so on. Financial leverage is also the relationship between EBIT and earnings per share, namely EPS. So the presence of fixed cost funds such as debt and preferred stock will result in greater percent of change in earnings per share than in EBIT. Besides, interest on debt and dividend on preferred stock are fixed financial costs. And financial leverage is also measured by the degree of financial leverage. Okay, the importance of financial leverage it helps the financial manager to design optimum capital structures, and it helps to bring balance between financial risk and return in the capital structure. Last but not least, the types of leverage is total leverage. Total leverage can be described as combined effect of operating and financial leverage. And total leverage is measured by the degree of total leverage or degree of combined leverage. The importance of total leverage is can manage and be careful as the high risk involved in the former is balanced by the latter. Point of indifference. It is the level of EBIT that generates the same EPS for combination of two or more methods of financing. It helps the manager choose between alternative cost structures is in the indifferent point. The indifferent point is also the level of volume at which total cost and hence profits are the same under both cost of structures. Okay, how steps to find the point of indifferent. Okay, capital structure such as interest on bond. So we can calculate it and find coupon rate in percentage times to existing BV. So the answer must be in total bond in RM. Second, dividend on preferred stock. So we can calculate dividend rate time to BV. So the answer must be in total PS in RM. And last, number of common share. We can calculate in value of common stock or par at or value of common stock or price minus flotation cost. So the answer must be in total notes in unit. Okay. Next, capital structure. Capital structure is how a company funds its overall operations and growth. It is also debt consists of borrow money that is due back to the lender. It is commonly with interest expense. Capital structure is also the equity consists of ownership rights in the company without the need to pay back any investment. So to understand the capital structure is both debt and equity can be found on the balance sheet. So the importance of capital structure is it is the goal of company management to find the ideal mix of debt and equity. It is also referred to as the optimum capital structure to finance operations. That's all. Thank you.